The IMF has raised its growth projection for China for 2024 and 2025. What's driven that decision?
So we've upgraded China's growth by 0.4 percentage points for this year and for next. So we have growth now projected at 5% for this year and 4.6% for next year. There are two main drivers for that. The first is the better than expected first quarter GDP numbers that came out for 2024. That is lifting up our growth projection. And the second is we have incorporated some of the newer announcements that have been made on the policy front. So those are the two main reasons for the upgrade.
But some say 5% is actually out of reach for China. They say private sector sentiment is still weak. The property sector is also in the doldrums. 16 million homes still unsold, and some point to China Vanka under a lot of financial stress. At some point, Gita, that is likely to weigh on confidence, weigh on sentiment, weigh on growth as well. What's your take on that?
So China's economy is continuing to recover. So we certainly are seeing that consumption is recovering, but still it has some ways to go. The strength we're seeing in public investment remains. Private investment is still weak, mainly because of the weakness in the property sector. So we are seeing signs of recovery, but yes, there is still more that we need to see more evidence of that. But I think despite that, we do expect that growth will be around 5% this year.
What more needs to be done?
So firstly, I would like to recognize the policy steps that have been taken. I mean, the recent announcement, which involves upgrading equipment of firms, but also consumer goods of households, that can help. But yes, in our view, more will be needed. And so specifically on the property sector front, I think what would be very helpful is to deal with the problem of pre-sold housing. So there are a large number of houses that have been pre-sold but have not been completed. Here, we see a bigger role for the central government to come in and to deal with that, to be able to complete those pre-sold houses. Because when that happens, that's going to help household confidence, which is really essential at this time, and also will help with the exit of non-viable developers. Secondly, in terms of providing support, while overall we think that there should be a fiscal neutral stance, I think it is important that the spending goes in the direction of helping low-income households, because they are the ones who are able to consume more of that additional income, and that will also provide a boost to the economy.
How are you assessing other risks? Some say that there's a risk of a new trade war. Of course, we heard from G7 finance ministers calling out China on its trade practices. We have the U.S. saying that it will reimpose those tariffs expiring, and we have China itself saying that it might impose 25% tariffs on imported autos from the U.S. as well as Europe. How might this play out? How might it impact China's economy as well as the economy of the world?
Yeah, I was just in Stresa for these G7 meetings, so I'm coming from there. And, you know, we're certainly living in times where there is questions being raised about the global trading system and the fairness of it. The IMF, as a general rule, we are strongly in favor of an open rule-based trading system, and therefore any disputes that countries have with each other, we believe, should be handled through the multilateral trading system, I mean, through the WTO. Now, there are concerns that are being raised. Industrial policies is something that comes up in conversations everywhere. Many countries deploy industrial policies. That has implications not just for their own resource allocation, but also potential spillovers to the rest of the world. And that is generating risks of greater fragmentation. But here's where we think it's critical for countries not to move unilaterally outside the multilateral trading system to address this, but to work with each other to strengthen the trading system, to come up with better rules of engagement when you have countries using subsidies, so that there's a common agreed principle on how to deal with these kinds of issues.
You talked about industrial policy, overcapacity. That was one issue that was raised to us by Le Maire in an interview with Bloomberg. He says that perhaps cheap Chinese goods will be detrimental to the whole global economy. How are you assessing that?
So firstly, I think when we are looking at China, we should just step back and recognize the the macro situation. So the fact that overall demand in China remains weak, we still have a negative output gap predicted for China. So in an environment where there is weak demand, of course, that's going to generate imbalances, and that's where action needs to be taken. Keep setting aside the implications for the rest of the world. Just for China itself, being able to raise demand is going to be very helpful. Secondly, again, for all countries, including China, that are deploying industrial policies, you have to make sure you're doing this in a targeted, in a manner which is also temporary. Otherwise, you're going to end up with just misallocating resources within your own country, again, setting aside the spillovers to the rest of the world. So for individual countries' perspective, it is important to make sure the resources get well allocated, and sometimes these industrial policies just distort signals, and you end up with a much less productive economy. So these are issues the countries need to pay close attention to.